Alright guys, I'm gonna do another video on OTE, making it a little bit more detailed and having better chart colors and everything like that. Not as much yapping. So pretty much what OTE is, it's gonna be your optimal trade entry, which is gonna be the best place to enter your trade, and having the best entry and everything like that. So basically all OTE is about where you are in your range. Your dealing range from your swing high to your swing low. Are you going to be in premium, equilibrium, which could also be known as fair value, or you're at the bottom half, which would be your discount, whatever the case may be. The way you would want to pull your dealing range is from the most recent swing high or to the most recent swing low, and whatever one got souped or stop hunted or liquidity got ran, whatever the case may be, that will be your most high probable dealing range because that's when you create a new one. So for an example, let's say you are in a buy position or you are going long, whatever the case would be, you're going to want to have your take profit higher and your stop loss lower. And then what you're going to want to do is you're going to want to enter as low as you can to giving you the best risk to reward ratio. So for an example, on this example to our left, we sweep this high, which this would be our new dealing range from this high to this low. And let's say we had some type of breaker block, IFEG, FEG, BPR, whatever the case may be, whatever PD raise we had, and you were expecting price to flip on it, and you wanted to enter around equilibrium, which would be 0.5 of this whole range, which also be known as fair value. You enter at equilibrium. If you want to play it safe, you put your take profit at the high, stop loss at the low. Your RR will be a 1-to-1, which is not ideal. Some people use it. I know a lot of people don't like it. Whatever works for you is whatever works for you. So instead of wanting to enter a position up here to take this TP and then your risk could be all the way down here, that's not what you want to do. You don't want to have a negative risk reward even down to here, 0.39. It's not going to work in your favor. So what you're going to want to do is identify the market structure as well. Right here, you can tell that we're bullish. We're making higher highs, higher lows. We do have a soup at this high, market structure shift, FEG, but since the overall market structure is bullish, you're going to wait for a retrace lower, souping other lows, seeing what higher time frame PD where we're going to flip off of. Do we have SMT at the lows, whatever the case may be, to give you the best entry. So instead of wanting to enter here, you're going to enter as low as possible, giving you that 1-to-1, or even, putting stop right here, which would be a 6.4. Instead of buying here, putting stop here, you'll be like at 3. All you're trying to do is mitigate your risk by having the higher risk to reward and not entering just because you have FOMO or you don't want to miss out on the trade or whatever the case may be. So for an example right here, this is going to be our bearish example. We have our high, our low. This low got souped. This will be our new dealing range. You're going to pull it from the low to the high, and then you're not going to want to enter your trade anywhere around here because your risk to reward will be lower. Let's say you were to perfectly enter around 0.7, put your stop at the high, take profit at the low. Your R is a 2.33 or a 2.3, whatever, which is definitely better than a 1-to-1. So when you are looking for a short position or you're trying to sell the market or whatever the case may be, you're going to want to enter as high as possible, giving you the highest RR that you can. And if you're looking for a long position, you're going to enter as low as you can or as least to equilibrium to maximize your RR potential. I have a few examples for you guys. On the daily time frame, we had this example right here. Yeah, we didn't soup it, but on on NQ we did soup it. So this would be your quote unquote turtle soup, which you'll pull it from this high, and then you have this low right here. High to low, this is your new dealing range. Right here we have this 4-hour FEG fill perfectly on equilibrium, and if you also pull it this 4-hour, it tapped the C of it perfectly, will be your 4-hour IFEG, making both of this a BPR, and your risk to reward will be a 1. The lower you could have entered, the better, but as right here, we had our higher time frame PD raise here, and we had equilibrium or fair value. That's all that we needed for this trade. And then for the next example, we have this one on a lower time frame. On the 15-minute, we could identify that we had a 15-minute FEG here. On a lower time frame, this would also be a high. This will be a high. So this was our equal highs right here. We soup these, tapping higher into this FEG, which would be the 15-minute TE, creating our new dealing range. We go down. This is our swing low. And if you were to pull it from your high to your low, we had our 5-minute FEG, CE, our internal soup, and then we had SMT right here with NQ as well. And their risk to reward would be 11.25 instead of you wanting to enter at equilibrium, which would have been a 2. So we're looking for shorts. The higher you enter, the higher your RR, and the most risk that you're being able to mitigate. So that's pretty much what OTE is. It's going to give you the best places to enter your trade, how to minimize your risk, and how to maximize your reward. And getting trades like this will also increase your win rate, because you're also going to be taking high probability setups that you like, setups that you know that actually work, and whatever exactly you would like to trade. This is a good tool, and a lot of people use it. You guys should use it too, and I'm just trying to explain it to you how you can use it and how it could benefit you.